Hello, my name is Dr. Adam Shadakovsky and I'm a research analyst at Kozak Kadara Securities. Today, I'll be talking about the discounted cash flow model, a model to estimate the fair value of a company's share. Firstly, I will give a short introduction with reference to Warren Buffett, and then I will formally introduce the model. The model is then used to evaluate three companies, including something called scenario analysis. Finally, I will talk about benefits and shortcomings of the discounted cash flow model and wrap things up. Just a friendly reminder that Kozak does not take into account the investment objective, financial situation, and advisory needs of any particular person, nor does the information provided constitute investment advice. For more information, visit kozak.com.au. Okay, so with that said, let's have a look at what the famous Warren Buffett is telling us about the discounted cash flow model. He's saying, if we could see at any business what its future cash inflows or outflows from the business to the owners or from the owners would be over the next 100 years or until the business is extinct, and then could discount that back at the appropriate interest rate, well, which I will get to in a second, that will give us a number for our intrinsic value of the share. As you can see, Buffett talks about discounted cash flow, and that is the key in the discounted cash flow model. Before getting more technical, I briefly wanted to relate the discounted cash flow model to other stock valuation models. The diagram here shows what are the most frequently used valuation models, according to a survey conducted in 2019. As we can see, the discounted cash flow model is at the very top, most frequently used model. Okay, let's go straight to the formula for the discounted cash flow model. Let me firstly talk about the term CF1. That is the cash flow generated by the company next year. More specifically, we will be looking at free cash flows. So what is that? Well, free cash flow is simply the cash the company has left after paying for the cost of running and growing the business. More formally, we say free cash flows equals to cash from operating activities minus capital expenditure. Let me now explain the term 1 plus R. As I said, CF1 is cash that we get in a year from now. That is not the same as having the same amount of cash in hand right now. Let me explain why. So for example, if we have $100 now, then we could invest that at a rate of return, let's say that rate is equal to R, and then after 1 year, we would have $100 times 1 plus R. So the value of that $100 in a year from now would be 100 times 1 plus R. Now doing the opposite, the present value of $100 received in a year from now is 100 divided by 1 plus R. This process is called discounting future cash flows to present. To get the present value of $100 received 2 years from now, we need to divide 100 by 1 plus R squared, and so on. So in conclusion, we see that the discounted cash flow models evaluate a company by adding the present value of all future cash flows for the company. In principle, that is all there is to it. But let us now look a little bit deeper into this and have also some examples. So firstly, one issue is that the formula has infinitely many terms. So how is that resolved? Well, the classical way to deal with this problem is to say that after n years, the company matures. And at that point, the company grows at a constant rate t called the perpetuity growth rate. Typically, that's set to something like 2 or 3%. Having this, we get that the cash flow in year n plus 1 is the same as the cash flow from the year n times 1 plus t. And similarly, the cash flow in year n plus 2 is the cash flow from the previous year n plus 1 times 1 plus t, and so on and so forth. Using this assumption, we can simplify the formula And the discounted cash flow model now becomes much simpler. So n plus 1 terms. And this is the final formula for the discounted cash flow model. Okay, we are now ready to look at examples. And we will start by looking at the mining company BHP. So the first step is to estimate the free cash flow for 2020 and the free cash flow for 2021. Here denoted CF0 and CF1. So for now, I will actually just show you the results. So for 2020, the free cash flow is estimated to be $2.74 per share. And for 2021, we estimate that the cash flow will be 7% lower. So now I want to explain how I got those two numbers, and we will see all of that on the next slide. Okay, let's start with the 2.74. This number is obtained by looking at the free cash flows over the last 4 years, as listed in the table to the left. To the right, I have illustrated how the free cash flow is changing over time. There we can see that there is a decline in the free cash flows. And if you apply linear regression, that is the best straight line fit, we see that in 2020, that line hits 2.74. That's the estimate we are using for 2020. So maybe you are wondering, why are we not using the exact number for 2020, which is 2.59? Well, the problem is that we will be using the 2020 estimate to make future predictions. So we want to apply something of a smoothing type of process to ensure that the 2020 value we use is not unusually low or unusually high. Okay, let's now look at CF1. That is cash flow in 2021. So the idea here is to look at the trend over the last 4 years. Looking at the graph, we see that on average, the free cash flow has been going down by roughly 7% annually. That is what we use to estimate the next year's cash flow as well. So in conclusion, our cash flow estimate for 2020 is 2.74 per share, and the estimate for 2021 is 7% lower than $2.74 per share. Okay, so with that, we are now ready to look into the future. Firstly, let's have a look at the perpetuity growth rate T. So we are setting that to be 3%. So we are assuming that eventually, after 10 years, the company will be growing 3% annually, in line with expected economical growth. What is left to decide? Well, we want to decide what will be happening in between the initial -7 per year decline and the final plus 3% per year growth. And you can see on the second row in the table how I decided that should evolve. So initially, in 2021, 2022, and 2023, there is nothing new happening. The cash flow continues to decline 7% annually, just like the last 4 years. However, afterwards, the decline in the free cash flows slows down, and eventually, the free cash flows starts to grow again. Okay, let's now briefly talk about the required rate of return R. That is $6.42 in the table. So that is the required rate of return, which is the minimum amount of profit an investor will require before he or she is willing to invest in a particular asset class. So for example, if you go to a bank, then you will be expecting a rate of return of say 1%. But 1% in profits will not make you invest in bonds or stocks because those investments are riskier. You must decide what rate of return you will require to be willing to invest in the market. So I have set this ratio to be 6.42%. If the stock market returns less than that, then I will simply not invest in the stock market. One more thing, the required rate of return may significantly change the intrinsic value calculated using the discounted cash flow model. If you ask for very high required rate of return, that will cause the intrinsic value to go down, making the companies look less attractive, making you buy less shares. In contrast to this, if your required rate of return is very low, the valuations will be higher and more optimistic, making the companies look more impressive and inviting you to buy more shares. Okay, now let's have a look at the numbers. So we see the free cash flow for 2021 is 2.74 minus 7%, which is 2.55. And discounting that to present, meaning divided by 1 plus R, gives 2.40. For 2022, the free cash flow drops to 2.37, and discounting that to present, or divided by 1 plus R squared, gives us 2.09. Continuing this way, we get all the first 10 terms. Finally, let's have a look at the last 11 terms. So notice that that is actually the same as the 10th term multiplied by a special fraction. So 1 plus t divided by r minus t. We call that fraction the terminal multiple. And here, the terminal multiple is 30.12. So to get the 11th term, you will need to take the 0.96 and multiply that by the terminal multiple, which is 30.12, and that gives you 29.0. Finally, adding all 11 terms, so 2.4, 2.09, and so on, all the way to $0.96, and to that add 29.01, gives you the final intrinsic value of the share to be $43.85. Okay, let's now compare that to the current share price. Share price is currently above 50, so this valuation is suggesting that the price is overvalued. However, let's now look at two more scenarios where the growth rates are different, more optimistic. So here I have allowed the cash flows to decline at a softer rate and start growing already in 2025. The intrinsic value of these assumptions is much higher. It becomes 67.80. So now let's have a look at an even more optimistic scenario. Here, all the free cash flows either stay flat or go up. So initially we have the free cash flows are not moving a lot, and then from 2023 the free cash flows starts to grow, eventually growing 3% annually. So as we see, this model is much more optimistic. The free cash flows are growing, they are never declining. So with these assumptions, the intrinsic value becomes $73.89 per share. Okay, so in summary, looking at different scenarios, we get very different estimates of what a share of BHP is worth. Now we need to consider what is the most likely of the scenarios. The main idea is to use past performance to predict future performance. Unfortunately, the past performance isn't very good. Over the last 4 years, the free cash flow went down by over 20%. So scenario 2 and 3 are perhaps not very likely to happen. Consequently, I have assigned a probability of 60% to the first model, where the decline is more significant. So taking all of that into account, we get an overall stock valuation of $54.64 per share. That valuation of BHP is actually saying that the stock is undervalued at present and there is room for the stock to grow. Okay, that's all that's to it. This is how stock valuation is done using the discounted cash flow model and scenario analysis. So here is just a small summary of all the numbers in one Excel sheet. The fields have in darker color are the numbers you get from company statements, and everything else is computed by Excel. So I just wanted to give you a few more examples. So if we look at CSL, that's really just adjusting the numbers in the fields that are a little bit darker in the color. So in particular, the free cash flow per share in 2020 is 4.19 per share, And as before, we use linear regression to make estimates for 2020. So that becomes $3.58 per share. That's the estimate of free cash flow that we are using in every single of their models above. So note that the only changes between the three scenarios above are changes in the free cash flow growth rates. For the first two scenarios, I use that the free cash flows grow very rapidly. So in fact, if we look at the numbers, we have free cash flow going from $1.62 per share to $4.19 per share over the last 4 years. That is a growth of about 37% per year. So in both of the first two scenarios, the growth rate starts at 37% per year, but slows down in two different ways. Finally, in the last scenario, the growth rate of the free cash flows is initially only 20% and then slows down very rapidly. So I have assigned the second scenario as the most realistic, and the other two scenarios are assigned a probability of 20% each. My reasoning is really the first scenario, the growth is just too fast, while for the last model, the very opposite happens and the growth is just unrealistically low. So we see that an overall estimate of CSL is about $301 per share. The current price is about $290 per share, so CSL is a buying opportunity according to this estimate. Okay, so finally let's have a look at one more example. Macquarie Group, ticker code MQG. This is a financial company having big swings in the free cash flows over the last 4 years. In fact, the free cash flows in 2020 were minus $6.39 per share. And even after linear regression, we still get a negative number. And that number is used for all the estimates in the model. So everything becomes negative and the final result becomes negative as well. So that's not very useful at all. What to do then? Well, let me try to outline one way we could try to fix this problem. So first of all, instead of using linear regression, we can just take the average of the last 4 years of cash flows. And that gives $2.74 per share. So at least we have a positive starting point. Secondly, we try to use growth in earnings as an estimate of growth. For the last 4 years, that was roughly a growth of 3.6% per year. Now, putting all of that in the table, we see that we start from $2.74 per share in free cash flows, and that grows by 3.6% annually until we reach a perpetuity growth rate of 3% in 2030. Using the same required rate of return as before, we get a final estimate of $86.42 per share. Comparing that to the actual value of the share right now, which is over 150, we do see that even if we really try, it is rather hard to use the discounted cash flow model to evaluate financial companies. And typically, the residual income valuation model is used to estimate the value of financial companies. Finally, let's outline the benefits and limitations of the discounted cash flow model. So this model applies best to companies with steady and growing cash flows. The model also works best for companies with small or no dividend payments. On the opposite end, if there is a lot of negative cash flows and there is no sign of improvements, then this model will not be very useful and might even produce a negative intrinsic value. In summary, after a small introduction including a quote by Warren Buffett, I formally introduced the discounted cash flow model. After that, the model was used to estimate the share price of BHP, CSL, and MQG. In particular, that included scenario analysis. Finally, I finish up with a brief discussion about the applicability of the model. In conclusion, while there are some restrictions on when this model can be used, it is certainly a valuable additional tool to help investors make more informed financial decisions. My name is Dr. Adam Shadakovsky, and this presentation was brought to you by Kotak Kadari Securities.